Welcome to this week's fund review. My name is Brian Williams from Northshire Consulting, a registered investment advisory firm, always working in a fiduciary capacity. Today, we're going to talk about the Vanguard short-term investment grade fund. There's a couple different ticker symbols, but for the purpose of this exercise and some of the performance numbers that we use, we'll relate back to VFSTX. All the holdings and the allocations are the same for all the share classes. The only thing that really matters is if we compare it to its peer group and the index. So the reason we picked this fund is in our Facebook group, each week we post a survey. We pick a Morningstar category. We pick the 10 largest funds in that category. Then we let the members of the group decide on which fund they want to see a more in-depth analysis of. So if you're watching this on YouTube, be sure to check out our Facebook group, 401k and beyond. That way you can ask some questions ahead of time about the fund or the category in general, and we'll answer them in this type of video. This fund is part of the corporate bond fund group, and the team that runs the short-term investment grade fund also runs the intermediate term fund. They also run a sleeve of the long-term investment grade fund. It's just 10% of the long-term fund. The other 90% is run by the Wellington Group. But it's important to understand the roots of this fund and the group that they're in, because as we work through the allocation, you'll see a slight overweight to corporate bonds. So to know the roots of where that came from is important. When we look at the first level allocation, you'll see about 95% of the fund invested in bonds, as you'd expect. There's no equity exposure here. And the majority of the bond portfolio is inside the US. This is not a fund that's going to have a large international exposure. The thing that's interesting to me on this page is the cash allocation. So cash refers to the part of the bonds that are the group that's just about to mature and has met their maturity date. So the fact that this fund doesn't have a large weighting there tells us they're a little bit farther out on that yield curve, and they're just underweighted to the ultra shortest of the short. So typically this category, you'll see around 9% of their portfolios categorized as cash. So significant underweight there here. Prospectus Benchmark here in this review is important because you'll see this fund reviewed against a couple different but similar benchmarks. So Vanguard benchmarks this fund against the Bloomberg Barclays Credit 1 to 5 year total return index. Morningstar, you'll see it benchmarked against the 1 to 3 year index. So that can affect how you put this up against its index and how the performance shakes out, whether they beat the index or not. The other reason it's important here is they've pegged some of their guidelines to the index now. So for example, their holdings in triple B rated bonds, they used to have a clear signal at 30%. They'd have to sell if they went over that. That was the maximum they could go. But now they've changed that, and it's based on the benchmark. They can go 10 percentage points higher or lower from where the benchmark is. So if the benchmark is at 25, they're allowed to invest up to 35% of the portfolio. So that's an interesting sort of guideline for this fund, that they're tied to the benchmark. A reminder that this video provides general education. Nothing shared in this video is to be considered specific tax, legal, or investment advice. And certainly don't act on any information you see in this video or the Facebook group without first consulting with your tax, legal, or investment advisor. We are an independent advisory firm with no affiliation to the reviewed fund. We may or may not have a position in this fund with client assets. Key data here, this fund has been around for a long time, 1982, and it's got $77 billion in the fund. When you look at holdings, if you're somebody who's more familiar with looking at equity-based mutual funds, for example, the S&P 500 is going to have around 500 holdings. Bond funds are typically going to have a lot more than that. First of all, the bond universe is much bigger than the equity universe. And you'll see a bond fund will have different maturities of the same corporation. So they might have their 3-year, their 5-year, their 10-year, different maturities across the board. So you're going to end up with a lot more holdings usually in a bond fund. Management here, you've had a little bit of a shakeup over the last few years. We'll talk about that more on the next slide. But that's important because this is an actively managed fund. And in an actively managed fund, you have a team of analysts and portfolio managers who decide which securities go into the fund, how much of those securities go into the fund, and ultimately when they are going to sell those securities, or just in the case of a short-term bond fund, just let them run to maturity. So you had a long-term manager leave in 2018. He was replaced by a couple of people in the firm who, they weren't new to Vanguard, but they were new to this fund and new as portfolio managers. And then they recruited a new manager away from State Street to help out the overall management team here. Expenses, we always talk about expenses and how important that is. And I could say that even in short-term investment grade or short-term bond funds, it's even more important. And here's why. In a fund like this, you're not expected to get outsized returns. You're not expected to get 20 or 30% in a year. When you look at the returns, they're rather muted just because of the risk return that they're profiling as. So we know when you're expecting returns in that 2, 3, 4% range, every basis point of expenses matter because it's coming right out of the return that you get. So this fund here is at 20 basis points, $20 for every $1,000 invested. And that's compared to 61 basis points in its peer group, or $6.10 for every $1,000 invested. And you'll see that work its way through when you compare it to its peers as far as performance. When you're that much farther ahead, 40 basis points, it's going to help you outperform your peer group in a lot of instances. So here's the two different share classes. We have an investor share class with that 20 basis point expense ratio and minimums of around $3,000. And then you have a fund that's the Admiral share class at about half the cost, but with higher minimums. So you might find at different custodians or in different programs, especially in a 401k or retirement plan world, that these minimums either don't apply or the minimums are a little bit different. But if you have the ability to get into the lower cost share class, you want to make sure you're there. Over time, Vanguard does a good job of reducing expense ratios where they can. They'll also do a good job of lowering minimums and ultimately merging these share classes together probably at some point. But for now, you want to make sure that if you have access to the lower price share class that you're getting it. When we compare this fund to its category, it's beat the category 10 out of the last 10 years. So, one of those reasons, like we said, was the expense ratio. If they're going to be that much less expensive, it's going to help them outperform their category. The other thing we talked about too is they're a little bit farther out on the risk spectrum than the category. So what that means is in up years for the category, this fund is likely to be up a little bit higher. So and when you have down years, same thing, they're likely to be down a little bit more. But as you can see here, over the last 10 years, the category and the fund have all had positive years. So that's a little more explanation for their outperformance. When we talk about these funds, we always say, we always want to talk about how these fit into your portfolio. But with this fund and this category, it's as important to talk about where it doesn't fit into your portfolio. This is not a substitute for, quote unquote, cash. It's not a substitute for your bank account, your checking, your savings, not a substitute for bank CDs. This is not a place where you want to chase yield, where you want to get a few extra basis points or even percentage points. If you've got a specific goal, let's say a year from now, and you might be tempted to say, well, I'll put some money in the short-term investment grade because maybe it'll get me 2 or 3%, whereas the bank is paying me nothing. So you don't want to do that. This is never a replacement for the short-term cash because you can see here, they can have drawdowns. They can have periods of negative returns. That could be a month, that could be a quarter. So you see, in March of 2020, as the pandemic started to, roll out a little bit, you had category was down over 3%. The fund was down over 3%. So you want to make sure that this is not a substitute for cash. And as it relates back to the 401k world, if you have a stable value fund, a lot of times they won't allow for a short-term bond fund to be in there. So, but same thing on the 401k side. This is not a guaranteed. This is not a substitute for a cash or a money market. So keep that in mind when you're putting your portfolios together, that this can have down periods. Always want to encourage you to take a look at the most up-to-date information like Vanguard.com to learn specifics about this fund and the different share classes, and also Morningstar.com to see where it fits in within its peer group and to get all the latest performance. Before we get into how we rate the fund and how it compares to its index, a reminder, if you're watching this on YouTube, to check out our group 401k and beyond. That way you'll have some say into what funds get reviewed on a regular basis. Here's how the fund stacks up against that benchmark. Remember, this is the 1 to 5 year benchmark, which you'll see Vanguard reference, not the 1 to 3 year, which Morningstar might reference. So, here you'll see some index outperformance, but again, very close. So this, remember, an index doesn't have an expense. So that's a situation where, you take 2020, the fund underperformed by 5 basis points, but that's because the index doesn't have an expense to work with. So it almost works the other way is when you're looking at the category ranking. So, a little underperformance here. It's only outperformed 1 out of the last 10 years. And some of that goes into just the holdings that they have, the fact that the index doesn't have the expenses we said. Now, if you were to look at this fund on Morningstar and compare it to the 1 to 3 year Bloomberg index, you'd see a totally different performance. Again, you'd see it outperform the index actually 9 out of the last 10 years. So it's interesting how just the different type of benchmarks can lead to you thinking this is a very good fund because it's outperformed, or not a very good fund because it's underperformed. Just a little bit different of the benchmark there. So how we rate this fund, we've got it overall as an A minus. Vanguard is a firm we like. The risk grade we give a B plus, and the return grade we give a B plus, only because we think there's potentially some other funds who might be a little bit better suited to do what you need to do. This is a fund where you really have to understand how it works and how it's rated and how its holdings stack up against the peer group and its index. This is a fund who has a lot less government securities, which tend to be a little bit more stable, and a lot more corporate securities, as we talked about, which tend to be, a little bit more volatile than government securities. So it's really important you understand that before you invest in this fund. And again, don't use this as a substitute for any sort of money market or cash reserve. So thanks again for watching this video. We appreciate everyone who voted on this video in our Facebook group. And if you're watching this on YouTube, check out that Facebook group. Thanks.